So welcome to
Okay.
Math 119-312, Mathematics Academics. We are going to have our third economy presentation today, so take it away.
Thank you. Good morning, everyone. Again, third presentation focusing on wealth distribution, unemployment statistics, and perhaps most importantly, to put everything into perspective, on consequences.
So the focus of our presentation, we looked at an article that I think should have been sent to you guys yesterday called The Coronavirus Recession and Economic Inequality, a Roadmap to Recovery and Long-Term Structural Change. And so this is a research article written by Heather Bushi, President and CEO of the Washington Center for Equitable Growth, and Soman Park, the Senior Research Assistant to the Executive Director. And so this article covers a broad scope of economy-related issues, and basically what we did is we each chose one specific solution or claim that the article mentioned, and we each decided to deconstruct the claim, examine it, and be pretty skeptical about its views. And so essentially we'll just kind of each go through our claim and some thoughts that we had about it. We would love to hear you guys' thoughts, obviously, and at the end, open it up for a little bit of discussion. Isaac, if you could go to the next slide. So the solution that I considered was the idea of keeping income flowing to unemployed and small business owners. So the article mentioned that so long as the new coronavirus continues to not have a treatment, there will be swaths of the US economy that will remain shut down or intermittently turned on and off. And so it's really important to make such businesses and families resilient to the crisis. And one of the challenges with this is that those first hit by economic crises are these small business owners and low-wage workers who have low cash reserves and benefits. So in the long term, we need more families with economic security, with access to different basic items such as a house, college, and things like that, that they can have without accruing a huge amount of debt. And so the article mentions that policymakers should use unemployment-based triggers that can ramp up and wind down quickly. So for example, business loans, unemployment insurance, direct payments, etc., and that families of these unemployed workers should definitely have access to healthcare. And finally, the article talks about in this section how as of mid-March, more than 90% of jobs lost were in sectors like accommodation and food service, which tend to be low-wage industries. And their source for this was the US Private Sector Job Quality Index in March 2020. Isaac, next slide. Thanks. So just some thoughts and concerns that I had about this section of the article. Just one thought, are triggers the best way to keep income flowing? And is this always an efficient solution? I don't necessarily have an answer to this, but I would love to hear what everybody has to think about this. I'm just not sure if this is necessarily the most efficient way of keeping income flowing to these workers. Then unemployment has a pretty strong relationship with economic growth and decay. So the figure to the right I found on the St. Louis Federal Reserve's website, and they had an article about this relationship between GDP reduction and the unemployment rate. And we can see that as the GDP reduction rate increases, unemployment rate also increases. So it seems like when there is an economic decay or a recession, there is a higher increase in unemployment, which has been talked about a little bit in the last two econ presentation groups, but clearly this is an issue, and with COVID, this could be a potential issue for these small business owners and low-income workers. Then also, how do we ensure that these programs to help small businesses and low-income workers aren't taken advantage of? So an example I thought of was with the Paycheck Protection Program that's been implemented already. A lot of large corporations have kind of taken out loans related to this as well, which kind of defeats the purpose of the program and takes away these loans from the small businesses that really need them. And finally, just a bigger question, how do economic shifts, such as increased automation, affect the job prospect of such communities? I'll talk about this a little bit in the next slide, but just the idea that in our kind of changing world, both technologically and just innovation-wise, there's a lot of changes in economy and job prospects that definitely could affect these low-income communities. Next slide. So as I was looking at this claim, I was researching other things related to it and other articles that talked about the effect to these small businesses and low-income workers. And I came across this Washington Post article that talked about inequality related to the coronavirus recession. and it called it the most unequal recession in modern US history. So if we look at the figure on the left, it shows a comparison between the 1990, 2001, 2008, and COVID recessions. And it shows the effect to the different kind of sections of the population. So the green line, which shows the highest earning 25% of the population, we can see that across all of the recessions, there hasn't been a huge difference between the effect to this population. With the coronavirus crisis, we can see that there has been a bigger dip, but overall it hasn't changed too much. But if we look at the purple line, which shows the lowest 25% of the population, we can see that the coronavirus crisis has caused a much bigger percentage dip in their earnings and their income compared to the other recessions. And so the article kind of uses this figure to talk about the claim that this is a really unequal recession. And it talks about how the nation has recovered nearly half of the jobs lost since the beginning of the pandemic, but certain key groups have recovered a lot more slowly, namely Black men and women, Hispanic men, Asian Americans, mothers of school-aged children, young Americans aged 25 to 34, and those without college degrees. And they talk about how this recession inequality is kind of a reflection of COVID-19 too, because medical-wise, the crisis has hit more low-income communities because they have less access to things like social distancing measures and ways, kind of different interventions that can help curb the crisis. And so on top of that, this recession inequality has hit them twice. So it's almost this like vicious cycle that they can't get out of. And then the article says that the Fed predicts that unemployment will not reach pre-pandemic levels until the end of 2023. Obviously, there's some uncertainty related to this speculation because we can't really be sure. But if this is true, it definitely poses a big issue to these communities. There's also, like I mentioned in the last slide, this paradox of automation. So basically, with the increased automation and technology, a lot of these jobs that these low-income workers would be having don't really need to exist anymore because they can be replaced with more efficient technology. And so with this evolution in jobs, there's this idea that there's another way in which these low-income workers won't have jobs. And so how do we kind of provide them with jobs in this different changing economy? And then finally, just thinking about another large relief package, because the article at the end of their discussion, they talked a little bit about potential other relief packages that could help small businesses and low-income communities. But I was thinking about a trade-off between providing monetary stimulus and fueling job creation, and kind of which one would be more beneficial to these communities. Claim that the big article talked about. And now I'm going to pass it over to Isaac, who's going to talk a little bit more about the markets and the role of government.
Thank you, Yushi. Okay, so going on with this question about, what's the solution? What can we do? What interested me in the article was this sort of claim, the claim that markets cannot perform the role of government, right? I agreed with this claim, it seemed to make sense to me, but I stopped to think, why do I agree with this? Can I find the numbers to back up this opinion, right? Not just try to find the data that fits my opinion, but find the data to make an intelligent opinion. The way I interpreted this is, in today's world, we see that the market is doing the job of the government in that it is sort of establishing the economic conditions that the rest of the people can play around, that they can work around, right? And it's sort of, in that way, it's completely contingent on the well-being of people. So it became a little mission, I'm someone without an economics background, what can I find, right? And so I found the perfect model. I thought, very broad thing, very many ways to tackle it. So let's look at a perfect modern example of corporate fiscal benefit, which is Tax Cuts and Jobs Act of 2017. Of course, the question is, what sorts of conditions did it set up for the crisis, and how did it play out during the crisis? And it's sort of pry on this idea: is the economy the best indicator for national well-being? Going over this, the tax cut briefly, it presented as a temporary tax change for individuals, permanent for corporate bodies. One of the biggest things that we see around is it was sweeping tax reform. You see the income brackets themselves, they were completely changed favoring mostly those in the upper half. And, most significantly with corporate tax rate was lowered significantly. Not only that, but it changed the US to a territorial tax system wherein individuals as well as companies pay only the tax rates of the country they are in, not of the US. This tax cut was meant to increase US investment. So we want to take a good look at that. And here in the Laffer curve, it's a sort of theoretical relationship between 0% tax rate and 100% tax rate, right? See how that affects revenue. And it's sort of the mission of finding the sweet spot. How can the federal government maximize the amount of revenue? So we're going to look at some of these indicators. We'll spend some time more on others than others. And again, keeping in mind U.S. investment, business investment, as well as national well-being, which will be interesting to think about. Now, looking at the units, right? We see this is the growth rate of U.S. retail sales, business inventory levels. What do we see before? We see a lot of flow, a lot of fluctuation business inventory levels, which tells us a good flow of capital back and out, into and out of the economy. And for retail sales, not a lot of change, which is, makes you wonder, what about the increase in disposable income of people, right? And so what we want to see here, I was talking to Michael Beatty. He's an alumni class of 1980. We see here the inverse relationship. He is an investment manager, right? And he was telling me to keep a close eye on capital. What does this mean for capital, for business inventory? We see the spikes at the onset of the pandemic and their current levels. Very important to keep in mind, what will these businesses that close down do with the inventory? How will this capital find its way back? We don't really see a huge increase in retail sales. So it makes you wonder what sorts of things will play out in the future. Will we have more buying power for people? Will we have more investment in inventory replacement or for opening new businesses? Right here, the current level. Now we're looking at home sales and existing home sales. New home sales can be anything from the signing of a contract to actually moving into the house. But what do we see here, right? Like, what is this? We can see it as a sort of moving, sort of the wealth accumulation, let's say. We see general not great growth in new home sales and a relatively stable existing home sales. But at the onset of the pandemic, what do we see? We see a huge spike. We see a huge drop and a huge spike. We have very low mortgage rates. We have a lot of people, we have this theme of accelerating trends. We had a lot of people jump right into the market, invest their money for after the pandemic, right? What happened here, however, is that we have started to see that the forecasts were being exceeded up to a certain point until very recently. We have not even yet reached the supply replacement level for new home sales. So it makes you wonder, taking immigration, population growth into account after the pandemic, in this inventory constrained market, how will things play out? So it seems that things were set up for good opportunity, but the benefits seem to be limited now. Now, looking at labor force participation, instead of employment, employment undercounts through joblessness because it fails to account for those people that are unwilling to work or were simply dropped out of the workforce, From 16 and on to 2017 and on as well, we see a fluctuation in the labor force participation, right? Not great, nothing great, right? But what this data doesn't reveal, we have to think about, we see a drop in unemployment rate in the last couple of months, but it's the question of, is this because people are finding jobs, or is this because people are giving up to find jobs, And we have to think about the delayed pandemic response, and not only the costs in the economy, the ability for people, the ability for the economy to make more wealth with labor. Also the cost in freedom. We have seen 3 times as many women drop out of the labor force than men. 3 times as many. That's something that will stick around for a while. We will see those consequences for a while. As a whole, in the last 2 months, over 4 million people were prevented from looking for work due to the pandemic, and therefore not counted as unemployed. So now switching the focus on the businesses themselves, right? Briefly, we see a linear growth in the number of small businesses in the economy, which gives us a positive outlook. We have something to look forward to, it seems so. Now we look at the business investment, right? Okay. private fixed investment is purchasing of newly produced fixed capital, right? While the real gross private domestic investment is the measure of replacement purchases plus net addition to capital assets plus the investment in inventory. Now, I don't show it in this data, but from 2012 to 2016, we saw a much more significant growth in business investment. And, you know, this is one of the things that I disagree with Michael Beatty. You know, he was telling me that after the Tax Cuts Act, there was a huge increase in business investment. And I was not really seeing it from the data. I mean, we see in 2019, there's a drop in the real gross private domestic investment. But of course, we see the spike, right? We see the spike in the investment in inventory. So we have to wonder, again, we see this trend of creative destruction accelerating the trends. But, you know, who is winning? You know, are things set up in a way that there is more competition after the pandemic? Or is it just that the big businesses are taking the place of small businesses, you know, consolidating their parts of the market? So we have to wonder about that. But looking a little bit more deeply, right? I read this very interesting article by the IMF. It was written in 2019. So it was looking at the relative effects of the tax cuts in the increase in business investment. And what I'll give you the main points. Basically, business investment has grown without a doubt, but it has fallen short of what one would expect in consideration of post-war relation to historical tax cuts. I mean, because this tax cut was very, very huge, right? Very significant. They used, in order to take into account the new economic conditions of our world, they generalized single variable autoregressive models so that each variable had its own equation, right? Its own evolution. What they found is decades worth of corporate markup across literatures, things becoming more expensive than their actual cost of production, rise in profitability and greater concentration of profit at the industry level, increase in monopoly rents, which means less competition, and all without a significant or any rise in production costs. And one of the things that I found most troubling in the article, that they ran surveys on the SP 500. 11% of these companies attributed their investment growth to the Tax Cuts Act of 2017. Only 11% of them. 4% of them reported redirecting investment into rehiring and business investment with the increased cash inflow. And 80% of these companies reported using this increased cash inflow for share buybacks and dividends. So it makes you wonder, there was a growth in business investment, and taking into account labor force participation, which we didn't see much of, as well as U.S. retail sales. So it makes you wonder, where are these effects, right? And what I liked about this article is that it really dug into the role of the increased market power in today's world. We have seen nothing like it in the past, right? And let's break down briefly this equation, right? We have the tax revenue over GDP. We have a ratio, right? We have the effective corporate tax rate, which is the blue term underlined, times the return of capital minus the depreciation rate. So it's sort of the profit, right? But I think most importantly, what we have to keep in mind as well is the one purple. The mu is the markup of price over marginal cost, and we have a sort of pattern, what I noticed in what we see in logistic equations, one minus this term, right? And what they found basically is that higher markups in price implied a less effective change in the increase in investment, right? We see a greater market power captured by the higher markups of price. And greater market power with larger markups implies a larger corporate tax to GDP ratio. And so basically, this tax cut was exaggerated. It was overblown, and it sort of ended up on the wrong end of the Laffer curve. It did not do what it could have done at all. And we see that it did not set up for the success of people during times of crisis. Now, switching the focus from the economy, right? Sticking our heads out of the numbers and looking, we're going to look at more numbers, but at the national well-being, what sorts of metrics can we sort of improvise to gauge the well-being of the economy? Well, health insurance coverage. You know, I dug around the U.S. Census Bureau information on health insurance coverage, and we see, I mean, I graphed it, I put the line of best trend. We see overall an increase of people without health insurance coverage. So that's something to be concerned about. Makes you wonder, you know, the tax cuts effect on the individual mandate, right? Next, we see mental health, mental illness. Now, this is important because the worker, how do we say, you know, the worker needs to be healthy. The worker needs to be able to perform their work. You know, if a happy worker is a happy economy. One of the most troubling numbers here is adults with disability who could not see a doctor due to cost, adults with any mental illness reporting unmet need, and as well as youth with at least one major depressive episode in the past year. We do not see a marked improvement in the mental health of people. You know, it's no secret that the financial stability of a person, you know, their ability to work, their ability to make earn a happy living, let's call it, is deeply contingent, I mean, on the mental health of the individual, and more so vice versa. And one of the things I noticed, it was a state-by-state analysis. I put all the information together. It was homelessness that was most significant in the prevalence of mental illness. And so I looked at the homelessness information. We see here, you know, it's sort of unclear. It was, in my opinion, it was unclear what we were looking at here, right? We see a upwards trend in many ways, and a downwards trend in many ways. So Milat helped us with her part of the presentation. I'm gonna put the video here. Excuse me. It's a recording because she was not able to be present. Okay. There we go. Sorry for the. And please let me know if the volume should be playing, but I just want to make sure. This is digging a little bit more deeply into the homelessness during the pandemic. Oh man, okay. Give me 1 minute.
While we're waiting, do you want to answer any of the questions in the chat?
Yes.
Or is it about to start?
That's a good idea. Let me look at the chat. Here it is. So, great mustache. Right. How much of the decline in unemployment among women was due to their children staying home rather than going to school? Well, I mean, a lot. A great amount of women they were compelled. They couldn't really do anything else. But these are not things that can just go back to normal. These are things that are going to stick around, unfortunately. We're going to see a lot of that play out in the future. I believe the video is playing now. I apologize for this terrible Wi-Fi.
The idea of addressing
can you hear it?
That the pandemic has had on
Let's just make it a little louder.
In a more personalized way, or rather in a way that affects communities, which is with homelessness. As I'm sure most of you know, the US is experiencing a large eviction crisis because around 25 to 30 people lost their jobs, and obviously that means that they're not able to pay their rent anymore. And were told to hold insurance for a while, but they're and a lot of and the pay that's
pause. It's very static.
So all the people issue. And like yeah, most of the government money that's been set aside to help those things hasn't been doled out for a lot of people. How in this capitalist world we live in, profit incentives and trying to make money, even in situations like this, which are completely unprecedented. The profit incentives to put money over people's lives. Why does this matter? Well, obviously,
please pause the video.
Problems to individuals.
Yes. Is it not? You can't hear it?
Yeah, people are saying in the chat that they cannot hear it. I don't know if this was recorded or because of your Wi-Fi. Email me the file. I will try to get it on my computer while you move on to the presentation.
Okay. I apologize about that. I hope you guys understand.
Worst case scenario, if you just send the video to the class, right?
Yeah, I can send the video to the class. I just, it's the point that, that I was trying to be made, that I hope you guys watch the video. The way things were set up, it was not for the benefit of most people. It sounds cliche, and I guess we can move on to the next slide. Going back to the original question, right? Are the rules fair for everyone? It sounds cliche, it's the same old story. The top get the most of the benefit, the bottom don't. What this Tax Cuts and Jobs Act did, it was a miscalculated fiscal policy that is exaggerated. It went to the point, it went right over the Laffer curve. It was not, right under the Laffer curve. It was not efficient. It set up these bubbles, right? For the people at the bottom, these bubbles is very easily burst under pressure of the crisis. And for those at the top, there were these globes that would not burst under any pressure. And so we not only think about the costs, right? In the labor participation, in all these inventory constrained markets, in business innovation. We also think about the freedoms of people. We're going to see these effects for a good number of years, and we have to wonder how much of that will be easily retainable. And just as a last thing before moving on, I learned a lot in doing the research, but I did realize it was very hard to find the information, and it's this question of access to information during this age, right? The information that, the role that information plays in this democracy. And I would like for people to think about this, right? And I talked about it in the Pandemics Through History presentation. How can a person be a participant in a democracy if there is no easy access or accessible way of getting this information, right? Like, for myself, I'm someone without an economics background. How much can I really tell from this data? There was a lot of discrepancies, even in the US Census Bureau's page. There were discrepancies in the data themselves. And, lastly, which metrics to use, we'll see in the next part of the presentation. But it's this idea, I think, that I want people to remember, is this economic literacy, right? Of taking opinion versus the ideology. What we saw, I had a claim, there was a claim in the article, and I worked through it. I saw the numbers for myself. Maybe I misinterpreted some things, right? But I do see that this Tax Cuts and Jobs Act, it set up things in a way so that certain people are very, very well prepared for crisis, and other people were not at all very well prepared for crisis. And sort of one of the things Michael Beatty told me that was the most important thing to do is, to ask these questions and try to find the truth for ourselves. And next we'll see which metrics matter most. Thank you.
Yeah, so if you read the article that we sent out, and I apologize if I'm having camera issues, but one of the claims that the article made was that one of the ways to move out of the recession was to create headline economic statistics that represent the well-being of all Americans. The argument essentially being something we've talked about a little bit in the past couple presentations and earlier in this presentation, but the idea that things like GDP are no longer really an accurate measure of well-being of most Americans. We can keep these numbers pretty inflated, but that doesn't necessarily mean that most people are doing well. The stock market's also a good example of this. When Elizabeth Warren was proposing her, I believe it was called the Accountable Businesses Act a couple of years ago, she came up with this statistic that 10% of the US population owns 84% of the stock market. So it's clear that you could have pretty significant gains in the market that really have no effect on a vast majority of the population. I think today would probably be a good example of that, with the market up 1.5% this morning, but that doesn't mean that the economic situation is getting any better, specifically for those 90% of Americans who don't own that significant portion of the market. But I think one of the flaws of the article was that it didn't really talk about what these statistics actually were. It basically just said what's bad, but it didn't say what's good. So that's kind of what I tried to look into a little bit, is what numbers and what metrics can we look at to get more clear of a picture, and to see what the well-being is of those other 90% of Americans, or even more than that, who aren't necessarily benefiting from a lot of these things. So if you go to the next slide. This is kind of just reiterating what I just said, but the pandemic and the ensuing recession made it clear that the stock market and the economy are really drifting away from each other. The stock market is not really an accurate measure of how the economy is doing, or at least how most Americans are doing. You essentially have a select number of large companies basically propping up the rest of the economy, but that's, one, probably not sustainable, and two, creates a significant gap in terms of who's doing well and who isn't, and doesn't provide the full picture that we're looking for. And then you also have, and I'm sure that you can kind of just extrapolate this from that statistic, but you also have a pretty significant gap in income inequality that's only getting worse. You have marginalized minority groups that, again, the pandemic hits groups like that much harder than it hits others. And like I said earlier, gains in the stock market don't mean that the American people are better off, specifically among low income earners. So if you go to the next slide, one of the things that I looked at was unemployment. And we've talked about unemployment a lot, so I took a little bit of a different angle to it. I looked specifically at that the second half of the slide, which talks about long-term unemployment. The top is the unemployment data that came out from the Bureau of Economic Analysis in September, or it actually came out in October, but concerning September, that basically shows that you have the unemployment rate declined slightly down to 7.9%, which leaves 12.6 million Americans unemployed. Those numbers have declined the last 5 months since March, but they're still not to the levels that they were in February in terms of unemployment. You can see that you still have roughly 6.8 million more people unemployed now than were unemployed in February, which is obviously pretty concerning. And given recent global trends in terms of reigniting lockdowns, that's a number that might balloon even more. And then long-term unemployment, and this will play into the next couple of metrics that I look at. But long-term unemployment, which is defined as people jobless for 27 weeks or more, so a little bit over 6 months, increased to 2.4 million in September. And when you combine that with the labor force participation rate decreasing, you basically wash out the, I guess, decrease in unemployment that we saw from August into September. So it's a little bit more concerning than even the numbers before. The employment to population ratio, which is essentially the number of people employed to the population of the country, is pretty self-explanatory, is 56%, 56.6%. And again, you're 4.5 percentage points lower than you were in February, which is, again, pretty concerning. It shows that we still have a long, long way to go to get the economy back to the levels that it was at before the pandemic. And like I said before, given recent global trends, those numbers might only get worse. And this is the most recent, if you go to the next slide, this is the most recent weekly unemployment data. I don't know if it's showing. Can you go to the next slide, Isaac? There we go. So these numbers came out on Friday. This is essentially just new claims from last week. new claims, there were 751,000 new unemployment claims in the United States, which was 40,000 less than the week before, but still obviously a lot and still pretty concerning. If you look at the two charts below, those are essentially a 1-year trend line of unemployment claims and insured unemployment. Obviously declining fairly steadily, but still higher than they were obviously this time a year ago. And again, we still have a huge cause for concern that these trend lines will spike back up again. So if you go to the next slide, moving away from unemployment, one of the things that I wanted to look at a lot was household income, essentially how much money do people have. So there are really two metrics that I focused a lot on. So just personal income, which is essentially just the money that people make from wages and then investments. So personal income in September actually increased $170.3 billion, which is 0.9% more than the month before. But obviously, if you look at the chart below, the personal income chart, you can see that the month before was not very good. So going from a decrease of -2.5% to an increase of 0.9%, you're still below where you were in July. And obviously before that, you can see that the trends were pretty negative and pretty troubling, and they still haven't really fully recovered. And then disposable personal income, which is essentially just income minus taxes, increased by roughly the same amount, which makes sense. And then personal consumption, which is essentially if you're looking at GDP and you extrapolate the consumption factor of GDP, that's personal consumption expenditures, increased 201.4 billion, which is again good. And you see in the chart to the right that that personal consumption number has been increasing since May, increasing at a lower rate, albeit, but still increasing. It's good that we had a little bit of a bounce back from September, from August. But again, from May, when you had a spike of 8.7%, obviously those numbers would have been pretty suppressed in March and April. But there's a good chance that government intervention stimulus checks had at least something to do with that. And obviously in the absence of those, that growth rate is declining pretty steadily, sans the bounce back in September. And the bullet point above just kind of explains basically what's going on in that chart. And then if you go to the next slide, these two charts, just kind of show, give you a little bit more of a visual representation of those two metrics. So the month-to-month change in personal income, you can see it's been pretty wavy. There's a lot of noise going on there. And you can obviously see that the declines sort of outweigh the inclines, specifically in personal income. May was obviously pretty devastating. June, not as much. Starting to recover in July, and again back down in August. So you would definitely like to see all of those numbers above zero, and you would definitely like to see the growth rate increasing over time. And obviously we're not seeing either of those things, which is very concerning. And then the month-to-month change in consumer spending, you can see how drastic that decline in the growth rate was, shooting up in May, specifically in terms of just people buying things, the orange goods section, and declining pretty steadily. So those metrics are pretty concerning. And again, you would like to see, especially as we potentially move towards more lockdowns, you'd like to see those numbers start to increase. And there's not much evidence to suggest that that is going to happen without some sort of intervention. And I'll hand it off to Jonathan.
Yeah, so I'm going to finish by talking about a couple factors that really make me concerned for the future and probably should make you concerned as well. Firstly, we're going to talk about individual financial fragility. The recession in 2008 sparked a lot of interest into what the financial fragility of Americans was at an individual level. And actually, 2011 study found that only about 25% of Americans were certain that they could come up with $2,000 for an emergency expense within 30 days. And a 2019 study found that almost 40% of Americans wouldn't be able to afford a $400 emergency expense. And so what we see here is that many Americans are really cutting it close and don't have large stocks of savings. And the implications of this during a time like the pandemic, we see that many Americans are relying on constant streams of income to survive, and will rely on income to deal with an emergency. So income instability and unemployment pose a serious threat to these people. I mean, if under normal circumstances they would struggle to come up with money for emergencies, like what happens if they lose their jobs? And it's starting to look like we could see things slow down again. So what are people without savings going to do if emergencies come up? If they can't pay rent, their landlords don't get paid, and then I'm seeing it's hard to hear. Is everyone having trouble?
Yes, it's staticky again. Try turning off your video
Oh, yeah, let me try that.
and enunciate into the microphone. Thanks.
Yep, I'll sit closer. So basically, if these types of people can't pay rent, their landlords can't get paid. Oh, perfect, better. And then they'll struggle to stay afloat, and we'll see a potentially detrimental economic chain reaction, which leads us to a question on the next slide. Could we use some sort of financial fragility measure to assess the risk posed by a second shutdown or outbreak? So I read into this, and a study by Filato and others found that illiquidity amplifies fragility. So I was thinking that we could use almost a quick ratio liquidity test for companies in at-risk industries. And the reason I pinpoint at-risk industries is because, someone in options trading, for example, is doing very well under these volatile conditions. So we're not really concerned about them. We're concerned about, airline industry, cruise ship industry. So we could use that quick ratio to potentially determine if a company or a set of companies is at risk in the event of a second shutdown or outbreak. For individuals, I think we could look at the percentage of people that could pay for a $1,655 emergency within a month. And I know this is a very, very specific figure, but it's the average deductible of employer-provided health insurance plans. So basically what someone would pay if they need COVID treatment, and there are about 157 million people on these types of plans. So it's valuable to know that if people can pay for getting COVID in the event of an outbreak. Next slide. And another cause for future concern, I'm going to look into what the Peri Project tells us about issues we may face in the future. So the Peri Project was a program that provided preschool to underprivileged children from 1962 to 67, be around $10,000 per child per year in today's money. And what this did was it quantifiably improved their life outcomes. We saw a rate of return about 16% economically. These kids did better in school, they committed less crime, they made more money than their peers. And interestingly enough, about 3/4 of the benefits went to society, only 1/4 went to the individuals. And what the implications of this is that early education has a significant impact on life outcome and benefits individuals and the economy in a significant way down the road and in the long term. And what's interesting is that young children are most greatly impacted by not being physically in school right now. So not having these kids in the classroom could have serious economic consequences in the future. And looking at this more broadly, I think it makes us realize that there will likely be significant long-term economic impacts stemming from COVID that won't necessarily reveal themselves for years to come. And I say impacts and not necessarily consequences because it's possible that technologies developed during this time will benefit our society in years to come. So potentially a little bit more of an optimistic note about that. Next slide. So to conclude, I want to show you a table that comes from a study done by David Cudler and Lawrence Summers, in which they estimated the total cost of COVID. So they basically predicted that we'll lose $7.6 trillion in GDP over the next decade, which is 4 times what we lost during the recession. And their calculated total loss of $16 trillion, which includes the essentially the losses stemming from people dying prematurely, having long-term health impairment or mental health impairment, would be around $16 trillion and is about double what the U.S. has spent on all wars since 9/11. A pretty crazy figure to think about. And it would equate to about what we would lose from 50 years of climate change. So I think what we're trying to underscore is this. We've seen massive economic impacts already, and based on these forecasts, we're nowhere near through this yet. So regardless of what we're seeing online in the stock market with GDP figures, even that Gallup poll that I think Josh just referenced, this is an economic crisis of massive proportions, and not really even all of the damage has been done. So for us students who will be entering the workforce soon, it's partially going to be our responsibility to help to rebuild the economy that the virus tore down, and we're going to have to understand that it's going to take a societal effort to do so. So thank you guys very much, and I think we have a couple minutes for questions.
Yeah, Professor Stephen, how many questions can we take?
It depends on how quickly you answer them and if there's follow-ups. So why don't you look at the chat and see if there's any ones that you particularly are interested in?
Yeah, if people in the group, if you want to take a question, go right ahead.
I guess since I read it, I'll respond to Josh's question about the Gallup poll. I think it's likely because there are so many measures that point to us doing better than we were 3 years ago that are commonly cited, when in reality that there are a lot of underlying issues that are making things not quite as good as they appear to be.
Do you want to do another question?
Yes. So I'm trying to find something that I can give something substantive for. Right, I guess, how do you think either individuals or companies respond to the constant changes in the tax code, especially when the investments under consideration are long-term ones? You know, really, there's a pretty big, because we saw what we saw here is that, you know, there's a lot of relationship with the markups, right? So I'm not exactly sure how to answer this question. Again, my economics background is very limited, but, you know, what I would say is that the more power one has in the economy, the more effectively they can respond to these tax codes, right? As I mentioned, we saw these bubbles forming that either burst very easily or that are very solid. So I think, you know, responding to the constant changes in the tax code, I don't think that necessarily needs to happen. I think what we should go, or, you know, push towards is, I guess, a sweeter spot in the Laffer curve, right? Not such an exaggerated tax cut that it ends up just doing the opposite of what it set out to do, as we saw in the charts. I think we're out of time. Okay. I hope you guys got something out of the presentation. That is our hope.
Well, thank you very much. And then we'll continue on Wednesday, and then there will be some other speakers who will be coming at various times. We may shift groups around a little bit. If your group hasn't told me yet when you want to present, please let me know. And then have a great day.